If the title of this video already didn't make you mad, you might actually be more angry by the end of this one. Today, we're going to talk about how the ultra-rich, and I'm not talking about your average millionaire, which is still a lot of money, but I'm going to tell you how the ultra-rich are able to avoid paying taxes. Maybe you've asked yourself this question: how do the ultra-rich, the executives, the Jeff Bezos of the world, pay less in taxes than their assistants? And I'm talking about them personally, not their companies, because that is an entirely different strategy, although having a corporation, or many of them, does help. Another disclaimer for you: you as a normal layperson will probably not have access to this simply because you don't have enough money. Executives make bank. That is not a secret. Many of them have wealth on a scale that is very difficult to imagine. It's also unsurprising that banks will basically suck your dick when you have this much money to keep you as a client. Now let's pretend you're part of the 1%. You have hundreds of millions of dollars, if not billions of dollars. How do you avoid paying taxes, and what do you get out of it other than the obvious paying taxes? First off, you get the prestige. You will also gain access to private investment managers, private bankers, world-class lawyers and accountants. All of these who know how to use a holding company to maximum effectiveness. Now, the services of these lawyers and accountants, guess what? That shit ain't cheap. Even if you don't have billions of dollars, a good lawyer and a good accountant are worth every dollar, but we'll talk about that later. Oftentimes, these lawyers and accountants can save their clients so much money. So much money, it equals roughly to what they would pay them in fees. For investment managers, at least in Canada, I don't know how this works in the US, you can deduct the fees that you pay for your non-registered accounts against your taxes. So even the fees you pay on your investments become tax deductible. So what do the banks get out of keeping clients like this? It should be pretty obvious: money. Gobs of money. Oodles and piles and mountains of money. Now, I'm not saying investment managers don't deserve to get paid as long as they're providing a value for the service. However, there is quite a gap between your everyday millionaire, someone who has between $1 and $5 million, versus someone who has 90, hundreds of millions of dollars. The fees for the client that has hundreds of millions of dollars will be significantly lower, because it's still better to get 0.1% on $100 million than it is to get 1.5% on $1 million. For those of you who are already doing the math in your head, congratulations, but that's the difference between $15,000 a year and $100,000 a year just in management fees. I would argue for your ultra wealthy, your fees would still be higher than this, but let's just use this for the sake of argument. The banks also like to keep this amount of money on deposit, or showing on the books, as it were, because of fractional reserve lending, which is a common practice that happens in the financial industry. I will do a different video on this because that is a topic all on its own. The short version is this: if a bank has $1 on deposit or on their books, they can then lend out up to $30 or even $40 for having $1 on the books. Also, a side note, it is kind of related to this, but it's just a point that I would like to make. When banks make fees or they report their earnings, a very significant portion, close to 50% in some cases, comes from their wealth division. That's from investment fees that they charge for their wealthy clients. There is a common conception that it does come from your average person's banking fees, and really, that's a very, very small piece of the bank's overall business. But I digress. Banks use one particular product to help their ultra-wealthy clients service a lifestyle that they want, or that their wealth affords them, without having to have a regular salary or a regular income like most people will need to prove. That would be credit. When you have the kind of wealth that ultra-rich people have, it's not typically in the form of just cash. They do have significant portions of cash, but most of their net worth or their value is tied up in either company stock options, investment portfolios, or real estate. Some might even say they're businesses, but if they own those businesses, then they're also shareholders in those businesses, which comes back to stock and investments. So let's use a hypothetical. Let's say you're Jeff Bezos and you want to build a new rocket to take your weekend getaway into space. That 4-minute space trip cost Jeff Bezos $5.5 billion for 4 minutes. 4 minutes in space $5.5 billion.
Because you guys paid for all of this.
Do you think Jeff Bezos just sells his investments, sells his real estate holdings, takes the cash, builds a rocket, and goes into space? No, that is not how that happens. What happens in Mr. Bezos' case, he walks into the bank, says, I have a company that is worth $1.7 trillion. I own it. I have some shareholders, but I am a significant stakeholder in that company. The bank then goes, great, Mr. Bezos, we would like to give you a line of credit which you can secure against your shares within the company. And he says, great, because I'm not spending my own money to do whatever the fuck I want with. Does he have to pay interest on what he borrows? Yes. Yes, he does. If he uses that money for more investments, does he get to write off the interest that he's paid on that borrowed money? Yes. Yes, he does. This is also why more and more executives are choosing to forego taking a salary from the company and instead getting paid in more stock or more stock options. Because if they get paid in a salary, that gets taxed as income. 100% of what they make is taxable. If they instead get paid in shares, then those shares are only taxed as capital gains when they sell them. So when you have borrowed money tied to your investment portfolio, you don't want to sell too much, but you also don't want to borrow right to the maximum either. The end result looks a little something like this. Ultra-wealthy executive did not take a salary from the company, so they have no income to report. They did get some shares from the company, which increased their net worth, but because these shares have not been sold yet, they have not made any money. There's just a paper gain. In fact, these very same ultra-wealthy people have actually made negative money because they have been paying their lawyers, they have been paying their accountants, they have been paying their investment managers and their investment fees. They've been paying their banking fees. They have been paying whatever other expenses they have related to running businesses. And because they have not sold anything, then they are running at a loss, which means you had no income, so you did not pay taxes in that year. Are you starting to see how this works? Is this starting to really piss you off? I haven't even really talked about investments secured against businesses or real estate holdings, but it's basically the same concept. However, if you're using a real estate portfolio and you put it in a business, it is then a business expense. There are then things you can write off for your property. You can actually devalue your property the longer you hold it in your company. I also haven't even touched on the strategy of buying a business that is failing and purposely sinking money into a failing business to prop it up for the purposes of getting more tax write-offs. That is also a strategy that is used. Tell me in the comments below what you think about all of this. If you want to learn a little bit more about budgeting for everyday people, please check this video out on your screen now. Don't forget to hit like and subscribe if there is some value for you. Have a great day, everyone.